In this video, I will be talking about horizontal and vertical analysis. Horizontal analysis is a comparison of the company's performance to itself in a prior year. Instead of just looking at multi-year results, it can be helpful to calculate the difference and the percent change. To calculate the difference, we take the current year and subtract the prior year, so that an increase is a positive number and a decrease is a negative number. We then take the difference and divide it by the prior year amount to get the percent change. This is a commonly used audit procedure. Those of you who have already had internships or taken audit have likely seen this before. Auditors will perform this calculation and then ask management to explain any significant changes. In this example, looking at the dollar differences, cost of sales jumps out as something we might want to know more about. But interest expense and income taxes are significantly smaller and maybe less important. However, when we look at the percent change, we see that interest expense has doubled from the prior year. So that might warrant investigation as well as either an auditor or a financial statement user. Vertical analysis scales all of the numbers in the financial statement by a common denominator, thus giving us an indication of its relative importance. In the example here, we see an income statement scaled by total revenues. When looking at the expenses, we can see that the biggest expense is cost of sales. That makes sense because a retail or manufacturing company will have most of their expense be the product that they sell. These relative amounts are often industry specific, so the 13% selling and administrative expense might be normal for this industry, or perhaps it's high and indicates poor expense management. Let's take a look at an example of horizontal and vertical analysis. Okay, so for this example, we have the comparative balance sheet for JMAR Company. So what we're going to do here is we're going to prepare a comparative balance sheet for JMAR Company showing the percent each item is of the total assets or total liabilities and stockholders' equity. Okay, so we're going to start out with doing our vertical analysis or scaling by a common size number. So what we're going to do is we're going to take cash, we're going to divide by total assets. Now for a trick of Excel, we're going to put a $sign in front of that row 21. And so what that's going to do is that's going to lock that in when we move this formula around. So we're going to say, okay, we want 2.09. Then we can come over here, and when we move our cursor to this corner, it turns into the black X. You can double tap that, and it's going to autofill our formula down the columns. And so what it did was it moved, every time it moved down a cell, it moved our blue cell down one because we didn't lock it. But it held on to our line 21, our red cell, because we told it to by putting that $sign in. We also can then take this and drag it over to the right, and that's going to move all of our formulas over one column. So again, we didn't lock in the column, so when we pulled it over, it moved our blue cell over one, and it moved our red cell over one. Then we're going to do the same thing on the other side of the balance sheet. So we're going to take our accounts payable, and we're going to divide by total liabilities and shareholders' equity, because that's the same thing as total assets. Again, we're going to lock in that row number and autofill and drag. So we can do these calculations a lot faster in Excel than we could with a calculator or by hand. Okay, so once we do this, we can take a look and see, kind of what jumps out at us. And so when we're just looking at the comparative balance sheets, we might not realize that the plant and equipment, for example, is so important to this company. So their major asset here is plant and equipment. Now, granted, it's net of accumulated depreciation, but it's still a significant portion of their assets. And so that's typically true when we have a manufacturing company. So manufacturing companies tend to have very expensive equipment and buildings. And more so than say other industries. So that might give us a clue that this is a manufacturing company. We also see they have quite a bit of inventory, which goes along with with what we're thinking. If we look at the other side of the balance sheet, we see that they have quite a bit of stock as opposed to bonds. So we have 56% versus 19%. And so that shows me that they have chosen to finance this company through stock as opposed to debt. And so companies may choose either. They might choose to issue bonds, and that is one way of fundraising, or they might choose to take on shareholders, and that is a different way. And so that just gives us a little bit of an indication of this company's strategy. We can also kind of look at these relative importance, right? So accounts payable seems to have decreased in relative importance year over year, while our short-term investments seems to have increased. And so that can tell us a little bit about what this company might have been doing. For some reason, they seem to have paid down some debts, so that's interesting. And they seem to have also taken on some new investments. So we're not quite sure what to make of that yet, but it's something interesting to have noted. Then we're going to do our comparative balance sheet of JMAR showing the dollar change and percent change for each item. So now we're doing our horizontal analysis. So again, we want to take our 2018 number, the current year, and subtract out the prior year to get our dollar change. So this account, cash, increased by $15,000 year over year. Then to get our percent change, we're going to take our dollar change and we're going to divide by the prior year because we want to know how much it's increased over last year. So that gives us 30%. We're going to take these guys, autofill them down, and it's going to calculate the rest of the accounts for us. Going to do it again on the other side. So again, we're going to take 2018, the more recent year, and subtract out 2017, the prior year. So in this case, the balance decreased year over year, so we get a negative number. Then we're going to take that dollar change and divide by last year's balance. So we see a decrease of 45%. And again, we're going to autofill. All right, so now we noted on our vertical analysis that accounts payable seem to decrease. And here that is even more obvious. We see it decrease by half. So it's half as big as it was in the prior year. And so then we start looking around and thinking, okay, well, what happened? How did they do that? They managed to pay off a whole bunch of accounts payable. Well, we see that their bonds payable increased by 25%. So it looks like they issued some new debt and that they used some of those proceeds at least to pay off their accounts payable. We also see that their short-term investments increased by 68%. So they also used some of their cash to increase their short-term investments. So they bought some new investments in that area. It seems like they also bought some new property, plant, and equipment. That increase in bonds payable was only $120,000, though. That doesn't cover all of those expenditures. And we see, if we look at retained earnings, that retained earnings increased year over year by $178,000. So that means that last year was profitable. They had, when they closed out their income statement, they brought over $178,000 of profits from the income statement into retained earnings. And so hopefully some of those were cash-based earnings as opposed to accruals that they then turned around and reinvested in the company through short-term investments and some of the property, plant, and equipment. So the point I want to make here is just that by doing this calculation, we made some observations about this company that might not have jumped out at us had we just been looking at their balance sheets side by side. So doing this analysis gives us kind of an indication of where to look and try to come up with an explanation of why these things happened. If this was a company we were interested in investing in, we would then look to their footnotes and see what they had to say about these types of transactions. This concludes our lecture on horizontal and vertical analysis. Be sure to email any questions for our discussion.